Welcome back, my friends. Commercial real estate billionaire Barry Sternlicht's firm just defaulted on a $212.5 million Atlanta office tower. What does it mean for real estate investment trusts? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Barry Sternlicht's Starwood Capital Group is in default on a $212.5 million mortgage backed by an Atlanta office tower, another sign of mounting distress in U.S. commercial real estate. The mortgage on Tower Place 100, in the Georgia Capital's Buckhead district, matured on July 9 and Starwood failed to refinance or pay off the debt, according to a filing compiled by Computershare. Borrower confirmed they are unable to pay off the loan at maturity, the filing says, adding the lenders have hired counsel and are negotiating an agreement. A representative for Starwood, with more than $115 billion in assets under management, declined to comment. Corporate landlords, including Blackstone Incorporated and Brookfield Asset Management Limited, have stopped making payments on office buildings they've deemed to be money losers as vacancies increased with the growing acceptance of remote work. In addition, borrowers' financing costs have soared as the Federal Reserve hiked interest rates to cool inflation and property values have declined. The delinquency rate for offices with commercial mortgage-backed securities swelled to 4.5% in June from 1.7% a year earlier, financing data firm TREP reported. Most CMBS financing is non-recourse, which means owners can walk away from properties without exposing themselves to further financial damages. Tower Place 100 was 62% leased as of the end of 2022, down from 87% in 2018 when the loan was originated. Among the 29-story building's biggest tenants is WeWork Incorporated, the office-sharing company co-founded by Adam Neumann that has struggled financially. The Atlanta area's office vacancy rate climbed to 22.4% in the second quarter, compared with the U.S. average of 20.6%, according to brokerage Jones Lang LaSalle Incorporated. Starwood Capital Group Chairman and CEO Barry Sternlicht warned in November about the adverse effect that Federal Reserve interest rate hikes would have on the U.S. economy. 8 months later, his prediction came true as his company defaulted on a $212.5 million mortgage backed by an Atlanta office tower when the loan matured on July 9. Acquiring a loan has grown progressively more expensive as the Federal Reserve raises interest rates to combat inflation. Last month was the first time in the past 15 months that the Federal Reserve didn't increase its key interest rate. The respite could be short-lived as at least 2 more increases are expected before the end of the year. Starwood Capital Group Chairman and CEO Barry Sternlicht warned in November about the adverse effect that Federal Reserve interest rate hikes would have on the U.S. economy. 8 months later, his prediction came true as his company defaulted on a $212.5 million mortgage backed by an Atlanta office tower when the loan matured on July 9. Acquiring a loan has grown progressively more expensive as the Federal Reserve raises interest rates to combat inflation. Last month was the first time in the past 15 months that the Federal Reserve didn't increase its key interest rate. The respite could be short-lived as at least 2 more increases are expected before the end of the year, according to the Fed Chair Jerome Powell. The higher interest rates have made housing purchases even more difficult amid a competitive market. Average rates are on the verge of 7%, nearly 4% higher than the average mortgage rate in January 2022. Borrowers also are struggling to repay their loans in the corporate world as they battle high rates. Starwood Capital Group is one of the latest companies to fall victim to the rising rates when it failed to refinance or pay off its loan when its mortgage on Tower Place 100 in Atlanta, Georgia, matured on July. Sternlicht predicted that the negative impact of the rate hikes would be delayed, preceded by companies diminishing their 2023 budgets amid worries of a recession. Economists are warning of a commercial real estate collapse as values for office, retail and apartment buildings have plummeted by 11% and could drop as much as 40%, according to Nick Gerli, CEO of Reventure Consulting, which analyzes real estate data. Starwood Capital Group is not the first corporate landlord to default on its loan. Other companies also are defaulting, primarily for office buildings amid weakening demand for the space due to the work-from-home push that blossomed during the COVID-19 pandemic. In February, Brookfield Asset Management defaulted on loans for 2 office buildings in Los Angeles because of a lack of demand for the space, according to Bloomberg. In Atlanta, Tower Place 100 was only 62% leased at the end of 2022, according to the report. In 2018, when the loan originated, the office tower was 87% leased. Not only are landlords battling open space, but loan financing costs have skyrocketed as the Fed continued to hike rates. It's going to slow the economy, Sternlicht said in November. Starwood Capital CEO Barry Sternlicht doesn't hold back on his Federal Reserve criticism. On multiple occasions he's told CNBC anchors that the central bank's aggressive interest rate hikes could soon spur a deep recession. It's easy to see why Sternlicht is so openly critical of the Fed. Starwood primarily invests in real estate, where the Fed's interest rate hikes have already caused a great deal of economic pain. Last week, Bloomberg reported that Starwood Real Estate Income Trust plans to shop more than 2,000 single-family rentals. Starwood hasn't publicly explained its motive for pulling back from the residential housing market, where its right owns over 3,200 single-family homes. That said, it's clear that the decision to shop these 2,000 homes comes as Starwood faces an uptick in redemption requests and endures pain in the commercial real estate sector. At first glance, one might assume Wall Street types would pull back from the commercial real estate space, where office values are sinking fast, and instead pile into the residential housing market, where national home values are rising again after passing through a mild home price correction last fall. However, institutional firms are also timid on the residential front. According to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes, bought 90% fewer homes in January and February than they did in the first 2 months of 2022. Why are institutional investors pulling back so fast from the U.S. housing market? It boils down to the fact that the financial return on each additional home added just isn't that great right now after factoring in interest rates, house prices, and rents. Not to mention, some big investors like Yield Street think that national house prices, despite jumping a bit this spring, are poised for another step down. We're pretty much on pause across all home buying strategies, Tejas Joshi, director of single-family residential at Yield Street, which owns over 700 single-family homes, recently told reporters. I don't think house prices have bottomed yet. On average, we have another 5% decline nationally, and it'll vary by market. Peak to trough, we're expecting 12% to 15% national decline. Not only are institutional investors buying fewer homes, some are reducing their overall single-family portfolios. Look no further than Invitation Homes, the largest owner of U.S. single-family rental homes, which recently became a net seller. In the first quarter of 2023, Invitation Homes bought 194 homes while it sold off 297. A year earlier, in the first quarter of 2022, Invitation Homes, which Blackstone helped to grow before divesting in 2019, bought 822 single-family homes and sold off only 147. Invitation Homes isn't alone. American Homes 4 Rent was also a net seller in the first quarter. In the first quarter of 2023, American Homes 4 Rent sold off more single-family homes, 666, than it bought, 312. That net decline saw the Las Vegas-based company's portfolio shrink from 58,993 rental homes across the country to 58,639 homes. A year earlier, in the first quarter of 2022, American Homes 4 Rent bought 1,131 homes and only sold off 171 homes. If you recall, Starwood REIT had a big management shakeup earlier this year. Starwood Real Estate Income Trust, the second largest non-traded REIT in the country, has swapped CEOs amid a turbulent time for the real estate market and an upswing in investors looking to pull their funds. John McCarthy, who served as Starwood REIT's CEO since its launch in 2017, was replaced by Sean Harris, who had been its president since 2021, according to a Securities and Exchange Commission filing first reported by CoStar. Starwood Real Estate Trust is limiting investor redemptions after the repurchase requests exceeded a 2% limit, reaching 3.2% of net asset value, NAV, in November 2022. The weakening commercial property market is another reason why private REITs including Starwood's and Blackstone Real Estate Income Trust are contending with high numbers of requests to redeem their shares. Blackstone launched the Blackstone Real Estate Income Trust in 2017. Blackstone's fund is called BRIGHT, which stands for Blackstone Real Estate Investment Trust. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BRIGHT. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. If you follow this channel, you already know that commercial real estate prices are falling across the United States. Rising interest rates have shifted the sands below what was once a strong and hot commercial real estate market. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.